Welcome back to Breaking Down Personal Finance, where we make money make sense. Ever wonder why some people use loans to build wealth while others end up buried under them? The difference isn't luck. It's understanding how loans actually work behind the scenes. Let's dig in, because loans are one of those tools that can either fast forward your goals or quietly drain them. When most of us hear loan, we think debt, stress, monthly payments. But here's the twist. Almost every major move in the financial world relies on loans. Businesses expand. Governments build infrastructure. Families buy homes. All powered by borrowed money. The trick is knowing when and how to borrow smartly. So let's start with what a loan really is. A loan is an agreement. You get access to money now, and you promise to pay it back later, usually with interest. That interest is basically the rental fee for using someone else's money. The lender gets compensated for the risk. You get the benefit of having cash you need today. Simple enough. But the details make or break the deal. Picture this. You borrow $10,000 for a used car. The lender charges 6% interest over 5 years. At first, most of your monthly payment goes toward interest, not the actual loan balance. That's because interest is calculated on what you still owe. This setup is called amortization, the schedule that decides how much of each payment goes to interest versus principal. Here's where people get tripped up. They think, if I pay $200 a month, it all chips away at my debt. Not quite. Early on, maybe $150 goes to interest, and only $50 hits the principal. But as the balance gets smaller, interest charges shrink, and more of your payment starts attacking the actual loan. It's like rolling a snowball downhill. Slow at first, then momentum kicks in. Now, not all loans are created equal. Broadly, we have secured and unsecured loans. A secured loan uses something valuable as collateral, like your home or your car. Because the lender can take that asset if you don't pay, the loan is less risky for them, and usually cheaper for you. Mortgages and auto loans fall into this bucket. Unsecured loans, like credit cards or personal loans, don't have collateral. The lender is betting on your promise to repay and your credit history. More risk for them means higher interest rates for you. It's like lending money to a friend with no guarantee they'll pay you back. You'd probably charge more too. But here's the twist most people miss. Interest rates aren't just about risk. They're also about time. The longer you borrow money, the more total interest you pay, even at a low rate. A 4% mortgage stretched over 30 years can cost you nearly as much in interest as the original price of the house. Shortening the loan term, even by a few years, can save you tens of thousands of dollars. Now let's talk about the flavors of loans you'll see in everyday life. First, the big one, mortgages. These are long-term secured loans for buying property. Because homes are expensive, repayment is measured in decades. The key lever here is your interest rate, fixed or variable. Fixed means your rate never changes, giving you predictable payments. Variable or adjustable rates can start lower, but fluctuate with the market. Great if rates go down, painful if they rise. Next up, auto loans. These are shorter, usually 3 to 7 years. The car acts as collateral, but it's a depreciating asset. It loses value every year. That's why long auto loans can be dangerous. You can end up underwater, owing more than the car is worth. Then we have student loans. Unlike car loans, these are meant to boost your earning potential. Student loans can be federal or private, subsidized or not. Federal loans often come with safety nets, income-based repayment, deferment, or forgiveness programs. Private loans tend to be stricter. The key is understanding the fine print before you sign. Education is valuable, but debt without a plan is heavy baggage. And of course, the wild card, personal loans and credit lines. These are unsecured and can be used for almost anything. Your interest rate depends on your credit score, income, and existing debts. Used wisely, they can simplify your finances. Used poorly, they can snowball fast. Let's zoom out for a second. Imagine you're building a house. your financial house. Loans are like scaffolding. They can help you build taller and faster, but rely on them too much, and the whole structure becomes shaky. Borrowing can accelerate your goals. Buying a home, starting a business, paying for education, but only if your future income comfortably supports repayment. Here's where good debt versus bad debt comes in. Good debt helps you acquire something that grows in value or increases your earning power. A mortgage on a home that appreciates. A student loan for a degree that boosts your career. Bad debt drains your future. Like high-interest credit card balances for things that lose value immediately. Before you borrow, ask, will this loan make me richer or poorer over time? But even good debt can turn bad if it's too big for your budget. A mortgage that eats half your paycheck can trap you just as much as a credit card. Borrowing smart isn't just about what you borrow for, it's about how much and on what terms. Speaking of terms, let's break down what you'll see in a loan agreement. The principal, the amount you borrow. The interest rate, the cost of borrowing, often expressed as APR. APR includes fees and gives you a clearer picture of the real cost. The term, how long you have to repay. And the repayment schedule, monthly, bi-weekly, or flexible. A simple example, borrow $10,000 at 6% APR for 3 years. You'll pay roughly $304 a month, and about $950 in total interest. Stretch that to 5 years, and your monthly payment drops to around $193. Sounds nice, right? Except now you'll pay about $1,600 in interest. That's the trade-off. Affordability now, or total cost later. Here's a mental trick. Imagine every dollar you borrow has a tiny friend named interest tagging along. The longer you keep the borrowed dollar, the more interest friends show up. And they all expect to be fed. The only way to kick them out early is to pay the loan off faster. That brings us to prepayment. Many loans allow extra payments toward principal, which cuts down interest dramatically. But some lenders charge prepayment penalties because they don't want to lose that interest income. Always check the fine print. Now let's talk credit scores, because loans and credit are inseparable. Lenders use your score to judge risk. Higher score, lower perceived risk, better rates. Pay on time, keep your utilization low, and avoid taking on debt you can't handle. Here's something people overlook. Using loans strategically can build your credit. A healthy mix of credit types, credit card, car loan, student loan, shows responsibility over time. The key is consistency, not perfection. So let's bring it together. Loans aren't good or bad. They're tools, powerful ones. Used correctly, they help you buy a home, build a business, or invest in your future. Used carelessly, they become financial quicksand. Understand the terms. Respect the cost. Be honest about your ability to repay. Quick recap. A loan is borrowed money you repay with interest. Secured loans are backed by assets. Unsecured ones aren't. Interest rates and loan terms determine the true cost. Good debt builds your future. Bad debt drains it. And your credit score is your borrowing passport. Protect it like treasure. If there's one takeaway, it's this. Borrowing isn't a failure. It's a tool. And like any tool, it's only dangerous if you don't know how to use it. Before you head out, don't forget to like this video, subscribe to the channel, and turn on notifications so you don't miss future episodes. We're building a community of people who want to understand money without the boring jargon or judgment. Drop a comment below. I'd love to hear what topics you want us to break down next. Maybe we'll dive into saving hacks, debt payoff strategies, or how to build an emergency fund. And remember, don't take financial advice from someone drawing doodles on YouTube. Learn here, research more, and then make the call yourself. Thanks for watching Breaking Down Personal Finance, where we make money make sense. See you next time.